So I'm going to share some tips to consider when thinking about changing your investment options. Now, first question. If there's a lot of volatility in the share market, should I change my super investment option to conservative? It's tempting, isn't it, to get out of the market during volatile times? But should you? Let me put it another way. Would you sell your house during a property market slump? I'm guessing only if you really had to, and the same should apply when it comes to changing your super investment option. Now, interestingly, when it comes to super, often the best course of action is no action. Let me explain. In a falling market, if you move your money, say, from a balanced investment option into a conservative option, you crystallize your losses. And in turn, if you don't get your timing right, you could miss out on the rebound when you do finally switch back. Time in the market rather than time in the market is probably your best tip right now. And if you're looking for some cold, hard numbers to give you some reassurance, then consider this from Industry Super Australia. At the last major market decline during the global financial crisis, retirement savers who moved their money from an average balance industry fund into cash would have missed out on investment returns of $4,000 after 3 months, $13,800 after a year, $34,800 after 5 years, and a massive $46,000 after 7 years. History does show that members who stay invested in growth assets and stick to a long-term plan can end up better off than those who keep swapping and changing their investment options. Yes, the share market has seen some significant falls in 2020 due to the economic impact of the coronavirus, which of course does have a knock-off effect on super funds. But you've got to remember this, that losses in your super funds are somewhat cushioned than those losses in the share market. That's because super funds do diversify risk by investing in a number of asset classes. A typical balanced fund, for example, would have just over half your money in equities and the remainder in infrastructure, fixed interest, and property. It's also worth noting some simple facts here. The first fact is that super is a long-term savings vehicle and performance needs to be considered over the long term. The second fact is that individuals who change their investment option choice to a more conservative investment option after equity prices have fallen normally do worse in the long term, as they may not be in a position to benefit from recovery in share prices. However, if you're still keen to switch, know that your fund may charge a small amount, a buy-sell spread, that reflects the transaction costs. And limits may apply on the number of times you can switch between asset classes. And it's really important here that you do get some expert advice before you make any impulsive moves. Next question. I've noticed my super balance has gone down considerably. When can I expect my balance to be back to normal? Well, I'd love to be able to predict the future, and the fact is nobody can, and particularly during unprecedented times such as the coronavirus pandemic. Let's take a look at the market shakeout that came out with the global financial crisis, or GFC as you may know it. Now, it saw values topple by 50% between October 2007 and February 2009. That's the share market values dropped by 50%. Now, despite the scale of the falls, the market recovered within 4 years by July 2013. Super funds recovered even sooner. Analysis by Industry Super Australia showed that a medium balance industry fund worth, say, $100,000 in September 2007, that's just before the GFC struck, would have dropped to $78,563 by February 2009. That's a top to bottom fall of more than 20%. It's not a great result, but a far lower fall than the overall share market. In terms of recovery, Industry Super Australia found that same balanced super fund would have returned to its October 2007 balance by March 2012. 3 years after the markets began to wobble, and just 2 years after the market hit its low point. The key takeout is that because super is spread across a variety of assets, it's less likely to experience the full brunt of stock market falls. The diversified asset base also means funds could bounce back sooner, potentially recovering their value ahead of global share markets. always important to keep a look at your super statements to make sure you know what's happening with your super fund. Here's to staying calm and seeking expert advice before you make any super moves.